Welcome back to the Turnaround Border. I am your host, Paul Maskill. This podcast is focused on serving home service business owners doing at least $3 million in revenue. All our conversations are real, no fluff, straight to the point. This conversation is about financial expert actually, what do they look at? Evaluating risk, survival, valuation in the home service space. All our episodes do discuss business, many times real business. So again, nothing discussed should be considered financial, legal, or tax advice for your specific situation. Every business is structurally different. Today we have with us Brad Wallace. Brad has spent more than 20 years in both M&A and small business ownership, in addition to transaction advisory experience at Bank of America, Imperial Capital, and now Calder Capital. He also owned his own commercial cleaning business for 8 years. So that is Brad Wallace. Brad, let's just jump into it. What do you do on a day-to-day basis? What's your exact role at Calder Capital?
We help business owners that want to sell. So we're a middle market, lower middle market M&A, mergers and acquisitions advisory firm. So if you have a business and you're looking to exit for whatever reason, retire, move on to do something else, we would help you sell the business and get the best outcome possible.
Awesome. So let's get right into that. Many times, most owners are only going to go through this process once, right? Like it's a legacy thing, especially in the trades. A lot have been doing it a long time. They founded the company. They were the technician. Now it's scaled. Now it's growing. And at some point, they're ready to exit. But obviously, they've never been through this process before. So what is that? Just kind of walk us super high level. Someone comes to you today, Brad, I think I'm ready to sell my business. What are kind of the expectations, in that process, starting from today until cash in the check?
For us, we would prefer to start with a formal business valuation. So we think it's important, to level set with the owner, but also get to know their business, right? Think about it. How is a potential buyer going to think about their business? I know, because I used to own a cleaning business, what I thought the business is worth might be very different than what the market thinks it's worth. So we want to dig into that. We want to really understand from the owner the strengths, the weaknesses. What are buyers going to find out as they get to know your business, and package that all up into a nice valuation that the owner can have. Now, that is not tied to selling the business. It's really just information that the owner can have. So if they want to say, you know what, there are 2 or 3 things that I can work on, and in 6 or 9 months, then I'll be ready to sell and get a much better price, that's great. If they say, you know what, I am ready to move forward and sell, that's fine too. But it's important to start with that exercise, because a lot of owners, especially for small businesses, they really just don't know what the business is worth. They just kind of think they know, or they throw out a number that they want, but it's not necessarily true with with reality, unfortunately, a lot of times.
So let's take the next step from there. Say I'm your client, say, yep, Brad, this is perfect. Love the valuation. It's definitely, within what I could retire on or do my next thing in life on. We say, yep, move forward. What do we do from there?
So we're gonna pull together marketing materials for the business. So there's really 2 documents. There's a teaser, which is a very short kind of blurb about the business. Then there's a confidential information memorandum, which is, call it, 25 pages of detailed information. For us, it's really designed to be everything a prospective buyer needs in order to make an offer on the business. So those are the 2 main marketing documents. For a broker like us, it's really our job to educate the buyers. So it really insulates the owner from having to deal with all the tire kickers. So I'm the guy, or someone like me is the guy on the phone talking to these owners, or to these prospective buyers, educating them on the business, and then asking them to pull together a formal offer in writing. Only once we get the offer, then does the owner have to get involved talking to these folks as potential buyers.
Gotcha. So yeah, that's super helpful. So you guys do obviously a lot of the, the vetting, and you get all these inquiries. You're going to send this out to all the people on your list. You're going to get all the people interested, and then they're going to say, yep, I want to make this offer. Then you get a bunch of offers. Then they say, owner says, okay, I like that offer. Now the owner gets pulled in. And I think this is where a lot of times owners might be like, I don't, what am I supposed to say? What should I not say? How long is this going to take? I don't know how much time. Walk us now through the next step. So we're having conversations with people who are interested, that we've accepted their offer. And what's the next steps from there?
Well, from there, really, in theory, you're talking to 5 or 6 or 8 of these parties that have submitted offers. really what we want to do through creating a competitive process is to receive multiple offers. Again, the point there is to give leverage to our clients. If you have one offer, you really have no offers. If you have 8 offers, then you have leverage to drive the best outcome, whether that's the price, whether that's the structure, the terms, et cetera, or timeline as well. So we would like to have multiple meetings set up with our clients and prospective buyers. It is an investment. It takes their time, but if they want to sell their business, they have to be prepared to commit to that. It's not full time, but it's busy on top of running your business. So it's not fun. I'm not going to promise that it's fun, but it's an important part of the process. So really, we're going to do those meetings. We're going to ask for follow up offers. We're going to pick our lead horse, and then we're going to move towards closing. So that's when legal documentation will be traded. That's when additional diligence will happen. So it can be, it can be a deep dive. Owners should expect that it will be a very deep dive. They'll be asked questions about their business that they probably don't think about. They probably don't think is important. But again, it's about giving a buyer comfort. And sometimes that means that answering a whole hell of a lot of questions.
Yeah. So we go through all that. And they're like, yep. The buyer's like, I love it. Due diligence, everything checks
Yeah.
out. They're ready to go.
Yeah.
They say, yep, deal is done. What's the, and again, I know everything's different. Like we said, this is not legal advice, not tax advice, not financial advice. But what are the rough expectations somebody can say if they said, yep, let's sell my business today? When will that thing actually change hands?
I would say 6 to 9 months. Could be longer, but 6 to 9 months.
All right. So,
And what it speaks to is that the owners need to prepare. Most owners for small businesses, including me when I owned my cleaning business, I was not running it for anyone else to ever look at. I was running it the way I wanted to run it. But if you're going to sell it, you really need to prepare. So whether that's working with like an outsourced CFO, someone that can clean up your books, someone that can help you, think through how to professionalize it, put systems into place. All these things are what buyers are going to look for, but they're important because they drive valuation. If you hand a buyer a bunch of bank statements and say, I don't really keep great books, I just run everything based off my bank account, all I care about is how much cash is in there, you are not going to get a very good offer for your business. So you really need to prepare is my point. You need to prepare if you're thinking about exiting, whether it's, immediately or in a year or 2 years, you really need to start preparing if you want a great outcome.
So yeah, so let's kind of let's get into that now, because obviously a lot of people are listening to this. They're like, I don't know if my business is ready to sell, or I do want to sell, but I don't think it's ready, or I haven't done it long enough. What are some of the what are some of the biggest things you see when businesses come to you? They think they're ready to sell. What are some like the big red flags that hey, these are the things you need to fix in your business before you actually try to bring this to market? What are like the top couple things that you see from underperforming businesses that they need to fix?
Owner dependency is probably the biggest. So especially in small businesses, the owner is the GM, they're the, chief cook and bottle washer. So they're doing a lot of different functions in their business. If they go away through a sale process, what is the new buyer really inheriting? Is it a job or is it a business? So owner dependency is a real problem in small businesses. Um, uh, Lack of systems, right? Keeping things on sticky notes in your office, right? Not having like a CRM in place to follow up on customer leads, the messy financials, those are all kind of the big ones that we see for small businesses.
Love it. So let's go back to the owner dependency a little bit, because you've probably heard this way more times than I have. But sellers are like, I only spend like 10 hours a week in the business. And then like when you really start to deep dive, they spend like 40 hours, plus they're super efficient because they've done it forever,
Yeah.
or it's going to take someone else 80 hours. What do you tell that person? Because I've talked to plenty of people who bought a business like, oh yeah, the owner said they weren't involved, and now we're realizing they were super involved.
Yeah.
What do you tell the people listening to that who think, I'm not that important to this business, even though they are?
I think they need to look at their business through the lens of an unbiased third party, because that is what the sales process is all about. And no one else is going to just fall in love with their business because they spent 20 years building it. But I do think it's easy to take for granted how, oh, it runs itself, right? I hear that all the time, right? It doesn't run itself. It runs it because you're there or people call you and you give them the answer. So it's very hard, especially, if you're not doing north of $2 million in profit every year, most businesses don't have a ton of human infrastructure, a ton of layers of management. So small businesses rarely run themselves. Uh, and yeah, owner dependency is generally pretty common.
Yeah. So
So
when you
hire a
guys,
GM. When I sold my cleaning business, the most attractive thing about it was that I had a GM in place. I lived in Texas. The business was in New York. So the biggest selling point for me was, guys, I'm not that involved. I live in Texas. The GM in New York runs it. Now, did he do a very good job? No. But at least a buyer was coming in to inherit infrastructure, right? Now that cost me a lot of money, which is why most business owners don't want to do it. You got to pay some expensive GM to run the thing, but it really does add a lot of enterprise value or equity value. So it costs you cash, but when you want to sell it, being able to say, well, Brad's the owner, but Steve, he's running the show. He's the GM. That makes it feel like someone's buying a real business. They're not just buying a job. And that's an important distinction.
yeah, no, and it's super important. And obviously, the seat I sit in as a fractional CFO for a lot of these companies, a lot of times when they, at least when they first come to me or when they're struggling with cash flow, it's, well, we don't have the money to
Yeah.
pay a GM because we're not financially healthy
Yeah.
and we got a lot of things to clean up. So I do see that a lot. So when you get a deal, you said the first thing you do is evaluation. What are the biggest things that you're looking at? Obviously, bottom line, and free cash flow and all that's really going to drive everything. But what are some of the first things you guys look at? Deal comes across the desk. Here's their financials. Let's do evaluation. What are the first things you guys look at?
I mean, stability is always important. A lot of small businesses, a lot of big businesses are very volatile, right? And now that COVID is in the rearview mirror, that excuse goes away. Everyone could buy the, oh well, 2021 was a down year, kind of, but that's done now, right? So stability is a great selling point for businesses. It's also important if somebody's going to need debt to buy your business, because banks do not care about the story. Well, our top sales guy, he was sick that year, so our sales went down. They don't care. They just want to see, well, what does the tax return say? So stability of financials is very important. Free cash flow is important, of course. Customer concentration is a big one, especially in small businesses. We see that all the time, is that they've got one customer, it's 40 or 60% of their revenue. And in the owner's defense, they say, well, they've been a client for 20 years. Like, okay, that's great, but that doesn't mean they're going to be a client for the next 20 years. And if they disappear for whatever reason, then all of a sudden the business that someone is buying just evaporates. So customer concentration is a big thing to look at as well. Yeah.
Yeah, and you mentioned, the example you gave, 40, 50, 6%, even 20 or 30%, whatever it might be. A lot of times, at least where I see it, it's like they're still doing some construction work or they're doing some remodel work. And they're convincing themselves that all we do is service work, but it's like, but we do like $1 million over here with this one or two builders. And to your point, usually those do go away once the business changes hands because that was
Yeah.
a relationship driven. It wasn't a marketing
Yeah.
machine. It wasn't predictable. It was, Joe's been a good friend for 20 years and, Joe's going to price shop once you sell the business. And that's just the nature of it because there
Yeah.
is no existing relationship there. Do you guys see or hear that a lot?
Oh, 100%. And from the owner's perspective, again, I've been working with Joe for 20 years. He loves us, maybe, but he also might just love you. And as soon as you retire, then he's going to take his business elsewhere. So really, the only way to bridge a gap there is through structuring some sort of offer, right? So maybe there's seller financing tied to the big customer. Maybe there's some sort of an earnout tied to maintaining the customer or some volume of revenue. But customer concentration is very, it's very heavily scrutinized. And I think owners take it for granted that just because someone's been a customer that they'll always be a customer. But again, if you're looking at through the lens of an unbiased, skeptical third party, then they're going to put a lot of focus on that. So, especially if it's not contracted, right? It's project based, like you said. Maybe it'll come back next year, maybe it won't. Like if there's a multi-year contract, that would be one thing. But
Sure. So let's kind of take it to the next level as far as numbers go.
Yep.
Obviously, you guys see books of all sorts: clean books, terrible books, messy books, no books, all everything in between. What are some of the most commonly inaccurate numbers you come across? Whether it's during due diligence, or you look at this, you're like, that just doesn't make sense. What are some of the biggest inaccuracies you see in the financial statements of home service companies when you're working with them?
I think just the accounting method, and this is probably something that you deal with all the time, Paul, like cash versus accrual. Most business owners, all they think about is cash, what's coming in, what's going out. But it can really skew how a buyer or how a bank would look at the numbers in terms of having it on an accrual basis, which is more complicated. And I know it doesn't, you can't pay your bills with accrual based accounting, but it's important to have somebody put your books in order. So that's always something that's up for discussion and a point of confusion. Other issues are working capital, this concept that when you sell your business, you're going to have to leave gas in the tank. So all your AR that you think is yours because you worked on it, you sold it, your guys did the job, like that some chunk of that is going to have to be left, with the buyer, and folks don't tend to like that. So I understand it, but it's an important thing to know going into it, right? So those are two big points of confusion that we tend to see. The other one is ad backs, right? So most small business owners, they either treat the business like a personal piggy bank, or they're very generous with what constitutes a business expense. So they take their husband or wife out to dinner and they pay with the company. They got their truck and the company pays for it. And they took a trip to Florida for vacation and the company pays for it. So some of those things you'll get credit for in a sale, but some of them won't. So you can't on one hand think you're going to, decrease the taxable income from from what you pay at the end of the year, and then somebody else is just gonna agree with you and give you more money for it. So keeping clean books is important. And I know you know that, Paul.
Yeah, and it's really that last point when, like, if you're trying to avoid paying taxes on a year-to-year basis, then your business just isn't going to be worth a lot. So it's like, what do you want? Do you want to make more money throughout the years? And more money is very relative compared to the valuation and the multiple and all that of what can go. But even and you see it all the time, and I see it all the time too, is like, once buyers kind of see those things, it just creates more and more red flags. They're going to do more digging, and they have the belief, which most humans do, of how you do anything is how you do everything. And if your books are a mess, or you're running all these personal expenses through the company, they're going to start questioning a lot of things, like the relationship with Joe, going back to the construction, or is they're just going to look at it way, with a bigger magnifying glass, fine tooth comb, because you're like, no, 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 wait, all that was personal expense, because now you're trying to maximize on the back end, even though you're trying to maximize on the front end as well. So,
Yeah, and we're doing
um,
that right now. We have a potential client, electrical business somewhere in Texas. I won't say where. We're going through and we say, all right, your business made about $1 million in free cash flow last year. He's like, no, it was way more than that. Like, well, that's what the numbers say. He's like, well, I padded the cost of goods with some of my jobs for some home improvement. So he put a pool in, he remodeled his kitchen, he built a horse barn for his wife. So yeah, they're personal expenses. Is any buyer going to give him credit for that? I don't know. So on one hand, he saved himself some taxes. On the other hand, it's really going to impair the equity value of his business. And so, let's say he saved himself $300,000 of taxable income. If you're selling your business at a multiple, call it 4 times, he's just cost himself $1,200,000
2 million.
in equity value. So it's penny wise and pound foolish sometimes, especially if you're getting ready for a sale.
Yeah, and then you look at what's the savings on writing off that expense, but you're not just writing off $300,000 of taxes, it's 300,000
Yes.
of expenses. So you're
Right.
just lowering your tax bill by a fraction compared to, oh, we could have made another $1 million on the exit
Yeah.
had we not done that. Eh, again, we see it all the time. So let's get into kind of the bottom line. I get the question all the time, so I'm sure you do, and I'm sure there's plenty of people out there listening. What is EBITDA? What do owners almost always misunderstand? Like, what is EBITDA, and how does that play into what's their business actually worth?
Yeah. So EBITDA, and you're right, it is confusing, but I would basically think of it as effectively your free cash flow. If you're in a CapEx heavy business, you got to buy trucks, you got to buy equipment. All of that is coming out of what your P&L says is basically your free cash flow, right? And free cash flow is going to be EBITDA minus CapEx generally. There's debt service in there. So that's what a buyer is going to look at, right? So but generally speaking, for someone that isn't super fluent with financial statements, I would just think of it as what is the free cash flow of your business. Um, and that number is going to be, really used with some multiple to figure out the overall value of your business. So if your EBITDA, especially if you're not CapEx heavy and services business, is $1 million, say, or $500,000, a buyer is going to assign a multiple to that, whether it's 3 or 4 or 5 times, and say, all right, if your business is doing $1 million in EBITDA, 4 times multiple, the business is worth $4 million. So I'm happy to define EBITDA for you if you want, Paul, but maybe that was just broad strokes.
Yeah, no, just go a little bit deeper, but not like into the weeds of if I'm looking like I'm a business owner, like you said, I have
Yeah.
$1 million EBITDA. What does that actually look like? Is that just the bottom line? What do we,
It's going to be
what are
your
we
net
doing here?
income. So go to the bottom of your P&L, right? Your net income. You're going to add back depreciation, which can be a hefty number. You're going to add back any taxes that are personal to you, not that the new owner would have to pay, like a franchise tax in Texas where I live. You're going to add back any amortization if there's any. You're going to add back any interest expense if you're paying interest expense. Now, the other thing that you want to do is add back personal expenses. So if you do have personal expenses and you can prove it, then we can add those back as well and come up with an adjusted EBITDA number. So if you have personal expenses, if you're paying yourself an above market salary, you can get a portion of that back. So, but generally that's kind of the proxy for it. Again, we would do this, we would do a deep dive, um, on behalf of any of our clients, but really we would want to come up with an adjusted EBITDA number, which is what is a new buyer inheriting from a cash flow perspective.
Love it. That's super helpful for everybody out there. So a couple things I want to kind of go back to. First thing you're mentioning vehicles and everything. So I want to hit on that.
Yeah.
I see this a lot. I'm curious what you see and what your take on it is. People in the trades like to buy vehicles. Their
Yeah.
CPAs love to tell them you had a great year, go buy a vehicle.
Yeah.
We look at their balance sheets. They've got so many vehicles and so many vehicle loans because then
Yeah.
they're doing the accelerated depreciation and da 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 da. Da. If I go sell my business and they say, "Yep, you're going to get a $3 million check," but I owe $800,000 on my vehicles. What happens to all those notes on those vehicles?
You should expect that a transaction would be cash free, debt free, which means any money that's sitting in your checking account, you keep it as the seller, but any debt that's on the business, you're going to pay it off. So if you have $800,000 of vehicle loans, you should expect that you're going to have to pay those off at close, and they will come out of the $3 million that you're selling your business for. Now, you could, depending on the situation, have the buyer inherit those loans. I'm doing an asphalt and paving deal in California right now, and there's $200,000 of equipment loans. The buyer is going to inherit those loans because it's at like 3% interest because they were from 5 years ago or whatever. So in that case, the seller is not paying those loans off, but it's still reducing the cash he's going to, take home at close. So you should assume that you've got to basically pay those off one way or another.
Yeah, and that's where I see a lot of people get stuck is they see the big number that someone's going to give them, and then you look at their balance sheet and it's like, well, you got this line of credit and you got this credit card, you got all these equipment loans and vehicle loans, and oh, you bought a side by side and ran it through the business and like all these other things. It's like
Yeah.
you realize you're going to transfer the title of all those things over, and like you said, unless there's a kind of a wrinkle in the deal, you're going to pay those off, get the clean title, and then transfer it to the
Yeah.
person who just bought
Well,
the
I
business.
think it's important to have help if you're going through this. Like you said at the top, Paul, this is probably the first time and only time, anyone listening to this would ever sell their business. They don't know what they don't know. And they very well likely might be selling to someone that is a professional business buyer. So do you want your life's work to be nuanced away by someone that buys 5 or 10 businesses a year? Probably not. So I think anyone selling a business needs help. And I'm happy to share a case study of a deal that we completed last year. It was an HVAC business in the Midwest. The owner called us because he got an offer, $10 million cash and a $3 million earnout, which is additional money he would get paid over time based on how the business performed. Well, he had never sold a business before. He called us. He said, I need help. So we did a professional valuation for him. It cost him $5,000 for the valuation. We found that his business would be worth anywhere from $23 to $24 million. He said, well, forget these guys. So he hired us. We ran a formal process for him, and we ended up selling it for $26 million. So I'm sure anyone who owns a business in this day and age is just getting bombarded with calls and emails from people that want to buy their business, or from people like me saying, I'll help you sell your business. But it's really important to have help, have representation, and create a competitive process. Because if in that instance, that guy just sold it for $10 million, he probably would have been happy, retired, smile on his face. Oh my gosh, I got $10 million. Well, he's probably a lot happier with $26 million, but he wouldn't have ever gotten that extra, generational wealth if he didn't run a formal process, if he didn't have some help. So it's very important, especially for owners that are getting calls from folks that want to buy their business, to have help.
Yeah, no, and I totally agree. And I've used brokers to sell businesses that I've owned before.
Yeah.
And y'all, it's worth, and we'll get into kind of what the fee structure might look like. Again, every business is different, but in my personal experience, they do all the heavy lifting, they do all the marketing, they deal with all the inquiries. You're going to get, if you're in the trades and you're going to take your business market, you're going to get flooded with hundreds, if not thousands, of people interested in buying your business, and you're going to have to go through them all. Or you hire a broker, M&A advisor to help do that for you, and you don't have to deal with any of it. So
Yep.
I know all our listeners are wondering, like, okay, again, like I said, every deal is different. You guys are going to figure this out. But generally speaking, what's a fee structure look like to hire an M&A advisor like you guys?
Yeah. So generally speaking, there are two components. There's a monthly work fee, or retainer effectively, and then there's a success fee. So the larger amount your business sells for, the better we do, right? So we're incentivized and we're aligned to help you sell for the highest price possible. For us, that monthly work fee is credited against the success fee. I don't know if that's always the case with everybody, but that's generally the most common fee structure we see in the market. So it's a monthly work fee and then a success fee. So,
Awesome. Yeah, and everybody listening, that success fee is going to vary depending on the size of the business, the work involved, all that. So I don't want to peg a number on Brad, but based on my experience, I've sold several businesses using a local M&A advisor broker here in my market, and it was anywhere between like 8 and 10% was their success fee. If you guys want to do some Googling, there's also a thing called a double layman where they're going to, as the millions stack up, the percentage goes down as well. So again, I don't want to peg anything at Brad. I don't want to make any promises, but that's my experience. I would recommend anybody, like we said, if you haven't done this before, at least talk to people and do your due diligence and see who can help sell your business and get that valuation and see what it might be worth. So let's keep moving on. We've kind of walked through the process. Now we're going to go to when the deals actually start happening and or falling apart. So what are some of the biggest deal killers you guys see out there? Hey, yep, got the offer. Yep, letter of intent signed. Now due diligence starts. Where do things go to die during due diligence? What are the biggest red flags?
things that come up, for example, oh yeah, that lawsuit, that's not that big of a deal. I'm sorry, I forgot to mention it. Financial performance volatility. As someone helping sell, I want it just to be nice and flat, maybe a little bit up. If it goes way up, the seller's going to say, well, we need a better price. If it goes down, the buyer's going to say, well, we need a better price. So financial volatility is a big one, especially if a deal drags on over time, right? Ego gets in the way. the seller's saying, I've answered all their questions. There's nothing else they need to know about this thing. And the buyer's saying, well, we have a couple more questions, right? So ego can get in the way. It's called seller fatigue. It's a long process. It's a roller coaster. It's emotional. I get it. But it's important. And then there's buyer fatigue as well, right? So keeping everybody communicative and proactive and providing information is important. That can stall deals. Overly aggressive attorneys or attorneys that don't know M&A. So if you hire your buddy who's a real estate attorney or a general business attorney, if those people aren't M&A attorneys, it's going to lead to problems, whether it's your attorney as the seller or the buyer's attorney. So you definitely need an M&A attorney to help you with your sale. Don't just hire a general business attorney. So those are factors. If the buyer needs third-party financing and they can't get it, that can be a problem. If the so that's probably the top of mind list.
Yeah, and I wrote down M&A attorney because I agree
Yeah.
so much with that. I know everyone's afraid of attorneys' fees and, "Oh, they're gonna charge by the hour," and blah, blah, blah. Like, y'all, I'm not an attorney, but every time I've used a business attorney, M&A attorney, depending on the situation, especially when selling a business, they've seen if you hire a good one, they've seen pretty much everything and they're going to know what to look out for. So when you are selling a business, historically, the buyer is going to create all buyer's attorney is going to create all the asset purchase agreements. They're going to create all the documents. They're going to say, all right, here it is. And if you don't have an attorney review that and working with you, there's a great chance you're going to sign something that you regret signing. That's going to cost you a lot more than the couple $1,000 that the attorney is going to charge you. Even whatever the attorney charges you, I promise you, if it's a good one, it's worth it. So, I do agree with that wholeheartedly. Let's get back. Let's get into. So you talk about buyer fatigue, seller fatigue. What about seller's remorse? Do you ever see it where like
Yeah. I mean, that
that?
is the number one reason why we want to have a discovery process before we even go down a path with somebody. We want to do the valuation. We want to charge them for that valuation. Everybody likes free information, right? But if they have to pay for it, it means they're serious about selling, right? And seller's remorse is a real thing. They need to understand how much cash is going to end up in their pocket at the end of the day. I want to hear from them. What are you going to do with your life after? When I sold my janitorial business, I didn't have anything else to do. I was sitting in my kitchen for better part of a year. And my wife is just staring at me like, what are you going to do? You can't just sit here the rest of your life. And I was like, I don't know. I didn't have a plan. And that's a real thing, right? So I want to know, what is the seller going to do? Are they going to volunteer? Are they going to go, retire out to a ranch that they own? Like, they need to have a plan, because in many cases, business ownership is someone's identity. They have their family and they have their business. And if their kids are grown up or they don't have kids, like what are they going to do? So the seller needs to have a plan. Otherwise, you're going to get to the precipice and the seller is going to say, you know what? I don't want to sell. And then the whole thing's for naught. So
Yeah. So I one last question on that, and then we'll kind of start to wrap up this conversation. So, obviously now, especially if PE is buying your company, a lot of times they're going to want you to stay on for a couple of years. So that kind of can help with the transition a little bit. But good, bad, and ugly. What have you seen when owners then stay on, and now they're basically running the company they built that they no longer are majority owner. They now have a boss. How does that play out in the world that you live in?
I mean, it can be a beautiful partnership, but it can also be incredibly stressful and gut wrenching. But yes, the realization that you are no longer the boss, right? And it depends on the structure, but generally speaking, they're no longer in charge of the company that they built. They're effectively an employee, and they need to hit probably pretty aggressive terms in order to get the full amount of the compensation that they agreed to in the sale. So structuring the terms of that is very important. And again, it goes back to my earlier point. If you have never sold a business before and you're selling to professional business buyers, there's a big information disadvantage, and it's not going to end well for you, right? So you need help, whether it's a guy like me or attorney or both, but you definitely need help in order to structuring that to be something that's amenable to you. But I think, private equity has a very kind of bad reputation in small business hood. But I think there are some great firms out there with great people, but I would not try to sell the private equity without somebody helping you because they can take advantage of you.
Yeah, for sure. And I think it goes back to your, the earlier point of like, what is your goal with this? What do you want to do next? Like figuring out their personality and what,
Yeah.
because there's a good private equity group for everybody. Everyone's got
Sure.
different
And talk
personalities.
to references. If they've done this 20 times, be like, great, can I talk to 20 other CEOs that have sold to you? Right?
Yeah.
A lot of owners wouldn't have the temerity to ask for that, but why not?
And here's the thing, guys. If you go to the private equity's website, they're going to be very proud of all the businesses they've acquired. There's going to be a list of all the business they've acquired. Reach out to them. Like the worst they can say is, I can't talk about that, or I'm not interested in talking about that. But especially in the trades, you go to any of these private equity groups, they're going to show you all their latest acquisitions. They're going to show you on a map and all the logos and all the cool stuff that they've
Yeah.
done. So I agree with Brad. Reach out to other owners. Like, hey, when did you get acquired? How's it going?
Yeah.
You know, is it up to your expectations? Is it what they told you it was going to be? Because there are plenty of great private equity groups. I talked to plenty of people who got acquired, quote unquote, partnered up with the private equity for the next 2 to 4 years, whatever it might be.
Yeah.
And they love it. They're like, we got all the resources we need now. We've got someone handling all the back end, handling Service Titan, so we don't have to deal with it. Like, you know, there are a lot of pros to it if it's a
Yeah.
group that fits with you and your goals. At least that's what I've seen.
Yeah. That's right. So
So our listeners are out there, they're like, this is super valuable. We've gone over a lot of things, but what is one thing, one owner behavior that you would recommend our listeners start to look at if they ever, like, whether they want to sell next year or 10 years from now? What's like that one thing that you would tell them, you need to stay on top of this, or you need to get on top of this, kind of, out of all the things we've talked about?
they just need to uh, take off the biased lens with which they probably look at their business. They need to think about it like an unaffiliated third party that doesn't care about the history, about how hard they've worked. How do they look at it and build the business, in that manner if they want to optimize their outcome. So it's very hard. When I had my cleaning business, it was so special to me, blood, sweat, and tears, et cetera, et cetera. But it doesn't matter if you want to sell it. Nobody cares how hard you worked for 20 years or how great of a life it afforded your family, right? Like they want to carry on your legacy, but they're not going to give you credit just for being a nice guy. So you need to build your business like a real business and think about it in an unbiased manner. And that's very hard for people, including me when I did it.
Yeah, I mean, it's super hard because we're so emotionally tied to, like you said, the blood, sweat, and tears. My take on that, like and it's the exact same, just saying it differently, is I tell everybody, look at your business as a publicly traded company, and would you buy stock in your company? If not, why wouldn't you? Well, it's not profitable, doesn't produce cash flow, isn't predictable. Like when we go to the stock market and we want to buy stock of a company, why do we want to buy it? Because it makes money year over year, because it grows year over year, because I don't have to be there. I can own part of Apple and I don't have to be there, right? Like the owner dependency. So all those things, that's what buyers are looking for, especially once you start to creep up into that, like you said, lower middle market. You're getting to the point where the person buying it is a company. A company is buying your company, and they're not just going to like go put themselves in the general manager seat and start working and start, going on calls and, filling in when Peggy can't answer the phone. They're not going to do any of that. So, and
Yeah.
they don't want to do
But
any of
there
that.
but there's resources, right? So if that message doesn't resonate with somebody, you can talk to an exit planner. You can talk to a guy like Paul. You can talk to a guy like me. Like we do this all day, every day. We can give you tips. We can give you pointers. You can hire people to help optimize your business, or you can go out alone and try to figure it out once you have a direction. But there are resources, so no owner has to do all this in a vacuum. So whether you reach out to me or a guy like me or Paul or a guy like him, then there's people that are willing to help. That's our job. So
Yeah. And I mean, it's so true, because a lot of times, we as entrepreneurs, what got us to this certain point isn't going to get us to the next level. The only way we can get to $2 or $3 million revenue is just by doing hard work and figuring it out, pushing the rock up the hill. Like that got us to a certain point, but now it's like, okay, now we need help, right? And the best businesses, they have they have people helping them. The best professional athletes have a coach for everything. So that way, all they have to worry about is one thing. LeBron James doesn't have to worry about what's he going to do for exercise, what's he going to do to cook, what's he going to do for recovery. And he's hired experts to do all those things for him, so he can just go be a basketball player. And I
That's right.
think
And
business owners need to do the same thing.
that was the realization I had when I knew it was time to sell my cleaning business, is that I was a terrible manager of people. And at some point, the business gets big enough where I can't just push it forward personally like I did when I started it. So I had to have people in place. But, I just know that about myself. I'm not a good manager of people. I learned it through doing a bad job managing it when I had a GM and realized, you know what, this business has a lot of potential, but I'm not the one to unlock it. So that's exactly what you said, Paul, which is, yeah, you gotta sell it.
Yeah, and we'll kind of wrap it with this, but Brad said it earlier, the ego gets in the way, the emotion gets in the way, but when you can eliminate those two, and someone like Brad or myself or anybody looking at the numbers saying like, this is what you got to do in order to get there, if the numbers are accurate, the numbers aren't going to lie. The numbers are going to tell you exactly what you need to do without the emotion involved in order to get to that number. If you go to someone like Brad and say, I want to sell it for 10 million, he's like, well, it's worth about 6 right now, but if you do these 3 things, do it for the next however long, your business is going to be worth 10 million. Now you're probably going to have to change your lifestyle. Maybe you have to tell your wife that we can't go on vacations on the company's dime, or maybe we have to hire a GM and give up control, or maybe we have to hire a service manager. A lot of times I see the technician founded companies like, oh, I'm going to be the service manager because I'm the only one that knows how to sell these things, and I'm going to tell these people how to sell it, da, da, da. Whatever it is. But at the end of the day, if you can remove your emotion, ego, and listen to other people,
Yeah.
you'll get to where you want to go. Brad, what do you got? Close us out. Anything to leave our audience with?
Yeah. If anyone is thinking that they want to sell, 2026 is shaping up to be a very strong year to sell. And I know I sound like a real estate agent. It's a seller's market. It's a buyer's market, but the data is there. 2025 was a great year for us. And there's just a ton of interest in businesses worth, $5 to $10 million. So there's a lot of people looking for assets like this. So if any of your listeners, are considering an exit at any point in the next couple years, like this might be a good time to do it. If they can get the price and terms that they want.
Love it. Thanks again for coming on the show, Brad. Guys, this is how professionals on the financial side of the trades look at things. We remove the emotion, remove the ego, and just get straight to the numbers. The numbers do not lie. If this episode resonated with you and you are ready to get your business financially healthy, head on over to thebluecollaradvisors.com. Or if you're looking to sell your business, again, reach out to Brad at Calder Capital. Brad, thanks again for coming on the show today. Really appreciate it.
Thanks, Paul. Appreciate it.